Hello, Joseph Noy here, connecting with you on Zoom, where we zoomed in members of our Latin America Treasury peer group for their 2020 first half meeting. Their region is being hard hit now by both the COVID-19 virus and the economic domino effects. I wish them all the best as they work to support their businesses and all their stakeholders in the region while keeping their families safe and well. Here are a few takeaways I wanted to share. First, rethinking intercompany funding. One member noted that most LATAM countries at her company have been funded on a standalone basis, which is challenging when banks locally don't step up with reasonable credit. For MNCs funding intercompany, they need to fit the region carefully into their strategic financing plans, for example, to tailor funds transfer pricing or their capital allocation models for intercompany loans, capital invested in the region, and cash pulled versus left in country. COVID-19 has vastly disrupted forecasts of local cash and capital needs. So going forward, members will look to improve forecasting capabilities in region and better integrate them with broader strategic cash and capital planning. Second takeaway, growing impatience with the lack of Treasury Center capabilities. Members expressed their growing impatience with the lack of progress in the region by governments and banks to allow them to implement world-class cash management and other Treasury operation solutions for Latin America. The region is simply not keeping pace with what is happening in other regions of the world. The impediments to world-class Treasury Center capabilities, for example, linking up affiliates to the in-house bank, makes it more challenging to meet the needs of members' businesses, customers, suppliers, and other stakeholders in this crisis. Finally, factoring in another Argentina crisis. As one member put it, this is not the first crisis in Argentina, so it's not as if the situation is new. Still, the most recent default on its debt has led to some new and innovative restrictions to accessing US dollars, members note. For example, there's been a call on companies with offshore dollars to use them to pay external vendors before being able to sell for their pesos. The only alternative besides that is to invest pesos in assets that yield something that helps mitigate the inflationary loss. So-called blue chip swaps and their bond equivalents still carry fears of reputation risk. Meanwhile, find a bank to help with factoring receivables so that you get those pesos to invest or spend as soon as possible. That's it for me, Joseph Noy, connecting with you on Zoom. For more insights like these, validated by NeuGroup members, visit neugroup.com. Stay safe and well.